Accounting can feel complicated, like a giant puzzle with too many pieces. But here's a secret. At its core, every financial statement, every transaction, every balance sheet is built on just one simple formula, the accounting equation. Mastering this equation is like learning the ABCs of accounting. In this video, I'll walk you through the basic definitions and then provide some examples using something simple and fun, a lemonade stand. The basic accounting equation is assets equal liabilities plus equity. Let's break down what each of these terms mean. Assets are anything a business owns or substantially controls that provide current or future economic value. Examples of assets are things like cash, equipment used by a business, inventory that's going to be sold, and so forth. The liabilities are everything an individual or business owes to third parties. Liabilities may include bank loans, credit card balances, or money borrowed by friends. Equity is also made up of things a business owes, but unlike liabilities, which are owed to third parties, equity is stuff a business owes to its owners. But there's more to it than that. Equity can also be broken down further into two parts. These parts are contributed capital and retained earnings. In simple terms, contributed capital are resources that owners put into a business. An easy example of this would be cash an owner uses from their personal funds to use to start a business. Retained earnings are the profits from a business that are reinvested in a business and ultimately due to owners. Retained earnings are calculated by taking the revenues a business earns, less any expenses, less any dividends paid out to owners. Now that we've defined these terms, let's explain how all these terms fit together, and then share some practical examples. The accounting equation is used to explain the relationship between what a business owns, its assets, and what a business owes to others, its liabilities and equity. Another way of saying this is that on the one side you have assets, and on the other side you have the explanation of how those assets are financed. It's important to understand that the accounting equation must always balance. If one side of the equation goes down, the other side must go down. This is because at the heart of accounting is the idea that there are two sides to every transaction, a giver and a receiver. With every transaction, something is given and something is received. Without one or the other, a transaction would be incomplete, or in other words, it would not balance. The accounting equation must always balance. Once you understand that every transaction has two sides, you've basically cracked the code of accounting. Let's break this down with a simple example. Imagine our stick figure, let's call him Alex, is starting a lemonade stand. Alex invests $100 of his own money. That $100 is equity. Since he uses all his own money and does not borrow money, there are no liabilities yet. With that $100, Alex now has cash to use for the business. The cash is now his asset. So when we put those numbers into the accounting equation, you will see that the equation balances. Or in other words, both sides of the equation equal each other. $100 in assets equal 0 liabilities plus $100 of equity. Or in other words, he has $100 of cash, which is financed by the money that he put in himself. Let's add in a quick concept question check. Alex buys $100 worth of lemons, sugar, and cups using cash he already invested. How does this affect the accounting equation? A. Assets increase, equity decreases. B. Assets stay the same, equity stays the same. C. Liabilities increase. Or D. Equity increases. The answer is B. Assets stay the same, equities stay the same. In this case, cash decreases, but inventory, another asset, increases. So total assets are unchanged. Equity is unaffected. Back to Alex. Now let's say Alex needs to purchase a table for his lemonade stand, but doesn't have the cash. He borrows $50 from a friend. That $50 is now a liability that he will have to pay back later. Alex now takes the money and uses it to purchase the table. How does this transaction affect the accounting equation? A. Assets increase, liabilities increase. B. Assets increase, equity increases. C, liabilities increase, equity decreases. Or D, assets decrease, liabilities decrease. The answer is A, assets increase and liabilities increase. Alex gains the table, which is an asset, and now owes $50 to his friend, which is the liability. So now Alex has $150 in assets. Those assets were made up of the lemonade supplies and table. Those assets were obtained from $100 from his own investment and $50 from the loan. That's $50 in liabilities and $100 in equity. Still perfectly balanced. No matter what a company does, the accounting equation always stays in balance. Every transaction, whether it's buying supplies, borrowing money, or generating profit, affects at least two parts of the equation, but the balance always holds. And that's why this one formula is the backbone of accounting. Assets equal liabilities plus equity. It's that simple. If you understand this, you've already unlocked the first step to understanding financial statements, business decisions, and even how your own career in accounting might grow. Now that's the basic version of the accounting equation, but we can also expand it to show where equity really comes from. The expanded accounting equation is assets equal liabilities plus contributed capital plus revenues less expenses less dividends. This version gives us more detail about how equity changes over time. It's not just the owner's initial investment, but also profits, losses, and distributions. So back to Alex. Now, Alex sells lemonade for $30 cash, some expensive lemonade, and the cost to make that lemonade costs him $20 per cup. Let's say he sells one glass of lemonade in exchange for $30 cash. Let's think again about how this will affect the accounting equation with our new expanded model when we now have the revenues and expenses. So here's the question. What is the net effect on assets and equity from this sale? A, assets increase by $30, equity increases by $30. B, assets increase by $10, equity increases by $10. C, assets decrease by $20, equity decreases by $20. Or D, assets increase by $50, equity increases by $50. The answer is B. Assets increase by $10, equity increases by $10. If he sells one glass of lemonade, he will receive cash, which is an asset, so his assets will increase by $30. Money received from sales are part of revenue, so revenue will also increase by $30. Now, additionally, Alex no longer has that glass of lemonade, with its related supplies used to make it, so his assets will also decrease by the cost of his lemonade, which was the $20 we discussed. The $20 cost reduces the assets, or in other words, the supplies decrease. This also counts as an expense, which reduces equity, again affecting both sides of the equation. Liabilities were not affected in this transaction. No money was borrowed or repaid, so liability stays the same. So that is a net change in assets of $10 and a net change in liabilities plus equity of $10, still balanced. Let's do one final example. Finally, Alex decides to take $40 out of the business for himself. So how does this transaction impact the accounting equation? A, assets increase, equity decreases. B, assets decrease, equity decreases. C, assets decrease, liabilities increase. D, assets increase, equity increases. The answer is B, assets decrease, equity decreases. Cash leaves the business, asset, and reduces what the owner has in the business, equity. That's a dividend or owner's draw. Therefore, the business equity decreases by $40 because it has been paid out and is no longer owed to Alex. Assets also decrease by $40 because cash is being removed from the business. Again, still balanced. There you have it. That is what is known as the expanded accounting equation. As you become more familiar, you will realize that this equation can be rewritten in many ways to explain the relationships of ownership within a business. The equation could also be written as assets less liabilities equal equity, for example. Understanding this equation will help you master the fundamentals of accounting. So the next time you see a balance sheet, you'll know exactly what it's showing, not just the numbers, but also how every piece of a business connects. If you found this helpful, make sure to like this video and subscribe for more Accounting Made Simple videos. I'll be breaking down more concepts like this in the future. And if you have a topic you'd like me to cover, drop it in the comments. I'd love to hear from you.